Hello, everybody, and welcome to my show, the show where I analyze stocks that are interesting. So, if you find that interesting, then please consider liking this video and subscribing to the channel. I'm your host, Michael Duke, and today I'm going to be talking about a very, very well known company that most, if not all, of my viewers have surely heard of. That company is DoorDash Inc., ticker DASA. Full disclosure, I've had an allocation to this in the IRA since it was at its lows far before I started making these videos. And I've always really liked the stock, and I will explain why. So, as always, I'm going to give a brief corporate overview, talk about what they do, keep that brief because, again, very clear what they do to most. I'm going to discuss the valuation, take a look at the numbers at a high level. I'm going to discuss if it has a moat. We're going to do some technical analysis, and I'm going to give it my grade. So, without further ado, let's get into it. What is DoorDash? DoorDash, of course, is the food delivery platform, experiencing a strong network effect as platforms that make it to a critical mass tend to do. Notably, the majority of the business is focused around food delivery. Let's just take a look at their website. Food delivery. I have driven for this company in the past, delivered for the company. I've utilized their services as a customer quite a few times, and as such, because they own the platform and rely on a network of independent contractors to deliver the food when somebody orders, it is an asset light enterprise based around the platform effect of the network effect of the platform, rather, that they've created. So they don't own the cars, they don't do the maintenance, they don't pay for the gas. Completely asset light. All they focus on is the distribution, the platform that facilitates the exchange of dollars and food. So right off then and there, I think it goes without saying that the company enjoys a wide moat. In fact, their brand is eponymous with food delivery in many circles. Oh, just DoorDash that. Yeah, I DoorDashed it. Not I got it delivered. I DoorDashed it. I DoorDashed this. I DoorDashed that. Very notable brand and platform. So yes, they have a wide moat because when somebody wants food these days and they're somewhat savvy with their device, they will go to DoorDash. And here's the thing: once you start using DoorDash, I tend to see that you continue to use it. In fact, I have an anecdote that I think really explains the hidden value of the DoorDash platform. I worked at a small company, less than 10 people, and one of the benefits of working at this company was that lunch was provided, and pretty cool, right? But what the company did was they ordered the food via DoorDash every single day, and when you have that kind of volume, when you're buying, again, it's only less than a dozen people, less than 10 people. When you have that kind of volume for food and you're doing it 5 days a week, you get the Dash Pass, 0% or $0 delivery fee on Dash Pass orders, 5% back on pickups, and so much more. Plus, yada yada yada. The idea is you pay a small subscription fee, and the incremental cost of each order is lower. Of course, the reason that this type of business creates value for consumers is allows them to substitute time for money. They can, outsource the, collection of their food to an individual and pay a slight markup on that labor. And the majority, the lion's share of the profits trickle back to the platform owner, being the corporation. So the reason that the company I worked for wanted to order food every day is because they believe that people were more productive when they, well, first off, having your lunch provided to you is pretty cool, right? And not just like pizza and donuts type food, but you know, an assembly of all of the decent spots around town that people like to eat at will be a part of the meal selection. So that's a pretty cool perk. But the productive aspect of that was that if people didn't have to do all this meal prep and they didn't have to think about what they were going to do for lunch or leave the office um, every day to go eat out, that people would spend more time in the office working with amongst themselves and with others on solving the challenges of the day. So through that aspect, not only are we, because we're exchanging, we're taking back time and paying for it with the platform like this. The theory there that I believe is true is that actually creates productivity in a workplace, in an individual, so on and so forth. But you do have to pay for it. So in theory, a service like DoorDash should make productivity go up. How do we measure that? We don't really at an aggregate level. But nonetheless, the numbers speak for themselves as this company went public in Q4 of 2020. That year, they did just a shade under $3 billion in revenue, and in the most recent year, 2024 full year, close to 11 billion. So we've almost 4 times, 3.67x our revenue. It's basically on a compound annual growth basis. It's grown by. I started to do that math in my head, but I can't. It's grown a lot. So the numbers speak for themselves in terms of revenue growth here. Whereas not only is this a valuable service to consumers, but it's immensely scalable, and has been reaching its escape velocity since going public. So that's the thesis, really, is in a world that's more digital, that's more expedient, that's more all about convenience. Me, for example, I do a majority of my work. I can do it from anywhere. When I'm recording these videos, I have to do it in my home. When I'm working on just about anything else, I can do it from anywhere. So, of course, I care about reining in costs, but I want convenience with what I'm doing. The local grocery stores are, just as an example, local grocery stores are just quite the endeavor to go check out anymore. There's so many people there. So I heavily utilize a service like Instacart, particularly through the Costco app. Almost just about any time I want, to have food that is from a third party, which frankly is a lot less anymore because I've been doing a lot more healthy cooking in the home. But nonetheless, I've really, over the last several years, I have heavily utilized services like DoorDash, just because they make sense for me. And I'm somebody who cares a lot about not having wasteful spending. and I do like to splurge on eating out, but I really keep a close eye on my costs the best that I can, and even through that lens, I found it very economical to use a company like DoorDash. So um, let's just take a look. I'm trying to think where. Quick corporate overview. Company operates the DoorDash marketplace, of course, and the Wolt marketplace, which I've got to be honest with you, I'm not really too familiar with what that is. Which provide various services such as customer acquisition, demand generation, order fulfillment, merchandising, payment processing, and customer support. It also offers membership programs, including Dash Pass and Wolt Plus, and DoorDash Drive On Demand and Wolt Drive, which are white label delivery fulfillment services, as well as provide services that help merchants establish online ordering, build branded mobile apps, enable tableside order and pay, and enhance customer support. The company was formerly known, yada yada. Founded in 2013, headquartered just down the road in San Francisco. What I would like to look at is not alone. I've done a 100% of my financial analysis through Seeking Alpha on this one. Look at this chart, by the way, like the Joker smile. So what I'm trying to do is get a nice presentation overview of the different business segments. Typically, I would revert to some sort of company deck. This is the CEO right here, Tony Zhu, one of the co-founders. He's on the Meta Platforms board. Let's just discuss more some of the additional thematic elements of an investment in DoorDash. So besides the core network effect, the platform, we have very, very strong potential through the ad business. Of course, if you've been on DoorDash, you know that certain items or restaurants that are located in there are sponsored. They're being pushed forward through ad spend. So anytime that there is a business that creates and provides a platform, there's of course strong potential for that platform to monetize through ads. And we're talking about primarily digital platforms, but really any sort of platform. If you have a public square in the middle of a busy city that's somehow privatized, you could make money on ads, right? You can make money on ads using real estate through billboards, right? Any sort of platform is a sensical location for an ad business to take place. DoorDash, of course, very, very strong upside for ad spend. And we do know that a couple of the asset-light ad spend centric businesses in the marketplace today, being Meta and Alphabet, that those are two of the largest companies in the world, part of the Magnificent Seven. So huge potential in ad spend, in addition to the marketplace fees. The company has also had some news related to acquisition on May 6th. So again, that's 2 months ago now, but DoorDash is acquiring this company, Deliveroo, $4 billion. Deliveroo, as far as I understand, is the European version of this. So that's just expanding into 7 million monthly active users in 9 countries, all of which are new for DoorDash. And they did the same. Okay, so this is what I was talking about. In 2022, they did the same for Wolt, or Volt, might be how you pronounce that because it's Finnish, for $8 billion. Okay, so they're just playing Monopoly now with purchasing peers. And then here, some interesting news. DoorDash and Flytrex begin drone delivery in Dallas-Fort Worth. Now we know that Walmart Plus has been messing around with drone delivery, but this is pretty cool, right? In DFW, used to live in DFW area, can now get their restaurant orders delivered by drone if the order is less than 6.6 pounds. DoorDash now offers the region's most expansive drone operating hours and highest payload capacity. So that's super cool, right? Because again, their business is already asset light through the mechanism of relying on a third-party contractor with a vehicle to pick up and deliver the food. However, we get drones to do it. Perhaps we can bring that piece in-house. But why we would want to do that, I'm not sure, because it's so asset light. The idea being that drone deliveries might be quicker for the smaller loads, and the technology will only expand from there. So you see the compelling thing about a marketplace where you can buy goods and have them delivered to you. Very, very valuable, because you see how the logistics, it's a logistics business, and a logistics business can do just about anything, can move just about anything. So right now they might only be doing food delivery, but in theory there could be a whole range of services, or really things that they move. And we saw that here, this announcement here, January 22nd. The Home Depot is now on DoorDash. World's largest home improvement retailer with over 2,000 stores is now available for on-demand delivery with DoorDash. This partnership brings home improvement essentials to both the doorstep and work site in as little as an hour. I see a lot of criticism of this company among very miserly people, or people who look down on others for their discretionary spend, and a lot of that is justified, I would say. However, this company, I think, flew under the radar a bit because of its more discretionary nature. But in theory, the marketplace can be used to purchase things that are less discretionary in nature. So before we take a look at the financials again, we looked at that chart. It's nudging up near its all-time high, basically at its all-time high here, that it sold off, 80% from all the way down the depths of this bear market, below $50 a share, and it's all the way about to break up again, translating into a one-year performance of 121% and a year-to-date performance 44%. Very, very, very strong performer. Not surprising. So we're going to talk about, is it still worth it? Well, we just take a look at their financials here, and I'm going to zoom in here to the quarterly. So again, that 2022 period was really the depths of a bear market there that it was hanging out in. 1.7 billion in that quarter in terms of revenue, and 770 of gross profit. So that's a gross profit margin hovering in the 40s there. Whereas here, in the most recent quarter, revenue of 3 billion, over 3 billion, and gross profit of 1.5. So gross profit margins have increased, indicative of strong moat and network effects. That's always a clue. Gross profit is going up over time. Again, this is a small sample size, but if gross profit is going up over time, it's indicative that the company might have a moat, or it's a commodity business in a boom. But this isn't what this is, right? So this is the kicker right here: operating income. We were operating at a loss, at a pretty, meaningful loss. In each quarter that has flipped, and in fact, in the third quarter here of 2024, the company turned a profit for the first time. And in that time, in the 2 quarters since, operating income is up 70% per quarter. Okay, very strong growth. I remember when before businesses like DoorDash and Uber and Lyft and all that, when these businesses were ascending and seeing all this activity, but not really, before they were public, there was a lot of criticism. Oh, these businesses are subsidized by VC money, they'll never be profitable. That's a fantasy. All of these businesses are profitable now, and in fact, they've reached escape velocity. So I believe that we're here in the early innings of what we might expect to see with DoorDash earnings from continued operations. A lot of noise here. One thing to point out is they're sitting on quite a bit of interest income here. That's allowed them to really just have a healthy looking non-operational income balance sheet here. Revenue per share going from 442 to 719. Now, one thing to keep in note: basic weighted average shares outstanding. Shares outstanding have gone up each quarter. They're issuing stock-based compensation clearly. Um, and another thing I noticed here while I was going through here, like right here, this is May 30th. Today announced the closing of previously announced private offering of $2.75 billion of 0% convertible senior notes. So because it's convertible debt, it could be converted to equity, thus increasing the average weighted shares outstanding at a point in the future when they are converted. So not only are we issuing stock along the way, but we are issuing convertible notes. So that is an issue, I would say, with the company. The share count is going up. However, again, I think the key here is that diluted earnings per share. Diluted earnings per share are what we really need to care about. We see here diluted earnings per share from negative 47 cents in the most recent quarter up to 31 cents from 23 cents in the 2 quarters prior. So very, very strong growth per share. And this is diluted, right? So it takes into account the share dilution. And you see that here in terms of EBITDA, we've gone, again, turning negative to now we're turning a profit, 166, 181, 237 million. So quite a bit of EBITDA growth. Again, we're reaching escape velocity. We reached escape velocity, and it looks pretty good. Now, in terms of their balance sheet, the balance sheet is pretty darn good looking. Okay? Pretty darn good. You see here, cash and equivalents continue to accrete in terms of these current assets, right? The current assets up 4.7 to 7.8. So they don't even know what to do with their cash. They got so much of it. They have very little equipment and property here. 2.5 billion relative to their liquid assets. Current liabilities being 4.5 billion, but there's no short-term debt. You see here, there's no short-term debt, and very small amount of accounts payable. Very small amount of accounts payable. These are accrued expenses. 4.5 billion of current liabilities. So they have more cash than current liabilities. Very strong position. Again, here, based on this, off the balance sheet, right? They have 5.457 capitalized leases, 143 million other non-current liabilities. So 5.1 liabilities, 5.8 of cash. Now again, here they're issuing notes. Now what's interesting is that the convertible notes. I guess one thing I'm not doing, 3 shares per 1,000. Is that showing up in your dilution? The thing that I'm trying to figure out is, okay, so they're issuing these. They're issuing this long-term or relatively short maturity. They're issuing these convertible notes, right? At 0%. So their debt amount. I guess this is the quarter ending March. So maybe that's why it doesn't show up. I'd be really curious to see in the upcoming quarter when they announce about a month from now how that shows up on this balance sheet. For the sake of time, I've already gone on. I'm not going to look at the balance sheet provided here, although it doesn't show up there, so this is accurate. I'd be interested to see how those convertible notes show up on the balance sheet, although I don't really think it's very material to the purposes of what we're doing here. For all intents and purposes, the balance sheet is very strong. They're issuing that debt to create cash, right? And it's at 0%. So and the notes are convertible. So in essence, they're really issuing, very, very cheap debt that might dilute in the future. So you do that when you're very confident that you'll continue to generate strong shareholder returns. But yeah, I think in terms of the cash position, the business has a very, very good looking balance sheet. The dilution of the shares, however, is a negative. But I wouldn't say that it's a material negative. It's not something that would keep me up at night here as a shareholder. So as such, their total debt, at least of this quarter here, very, very low. Very interesting, very healthy looking balance sheet with a few very, very minor concerns, but healthy nonetheless. We take a look at the valuation. The stock has gotten incredibly expensive, and we'll take a look at why here in a moment. But we see, pretty much by every metric, except for price earnings growth ratio on a forward estimate. That's a pretty good pay. I don't know why, but I would assume that it's because it hasn't been profitable. It's only been profitable for the prior 3 quarters. A lot of the times this doesn't show up, I've noticed, in Seeking Alpha. By virtually every metric here, stock is incredibly expensive. I would expect the price book to be very high. However, the price sales ratio, almost 10 times sales, that's super expensive. Enterprise value over EBIT, 117, EBITDA, 36 times. On a trailing 12, it's incredibly expensive. And price earnings gap, 114 times on a forward basis, 52 times non-gap. So even on the strong growth, we got a forward valuation of 52 times. That's pretty nuts. But what about our growth, right? Again, we looked at the quarterly financials. Revenue almost doubled in less than 3 years, right? So that's incredibly, incredibly strong growth. We see here revenue growth year over year, 23 a third percent. Revenue growth still in the 20s projected forward. EBITDA growth 44% estimated. Earnings per share forward long-term growth, 3 to 5 year compound annual growth rate of 40%. Free cash flow per share. Again, these are all estimates. Super strong growth metrics. How much would you be willing to pay for a business growing that fast? Costco is growing nowhere near these numbers and is trading at nosebleed valuation on a non-GAAP basis. Forward price earnings roughly in the stratosphere of this, right? Which one looks more expensive? And which one has a higher growth ceiling? Good question. I have a lot more Costco stock than DoorDash, by the way. But the thing about growth stocks like this is looking at the price earnings ratios. Look at the price earnings ratios, but don't let it scare you. Don't let it scare you when it doesn't look good. I think the key there is ascertaining momentum, both in the numbers and in the stock price. What we're seeing now is the revenue numbers have gone up and profit has been flipping from negative to less negative to less negative to positive to positive to positive, right? And this period was, pure market-based sell-off. This, of course, was when the stock market as a whole sold off and stock price really cratered. But what we're seeing here is very reasonable level of price appreciation, just given the inherent fundamentals of the stock. It's not a deep value, but what I do find interesting is the fact that we are here. We are here at the moment, basically at right up against the all-time high price. I think technically that's a very, very, very interesting scenario here, and while we're at it, let's just draw a chart. All right, so now we've had 3 points of resistance there that we failed to break out from, except not until bear market low did we actually see the stock starting to reach upward momentum. Now we do. So this right here, if you just ignore that part of the chart and you look at this, right? That's super bullish because we were in this like ascending channel that accelerated up and then the price broke out. However, now we're being met with the long-term resistance. Okay? So we're at a critical level right here. If we break out to new all-time highs, which we might, right? We might because again we've got really strong underlying fundamentals, even with the very modest share dilution aside. We've got incredibly strong uh, numbers, and that's really backed up by a common sense view at the network effect. I think that this company has a long runway for growth to the future across many markets, across many different types of goods, services, and whatnot. Sky is the limit. So, could it break out above this all-time high price? Well, I certainly think so. But will it do so within the next few trading days? Well, not clear. Certainly, breaking down today, you see this down to something percent. Um, but I would say fairly bullish looking chart because if we break out above that level, another stock I covered is Corteva. Okay, Corteva had a chart that looked similar to this, albeit much more stable, where it was butting up right against the all-time high. Well, what happened? It went up 20% after it broke above the all-time high. Corteva, ticker CTVA. Okay, that's kind of what we're dealing with here. We're nudging up against this critical technical level. If we break out above, we could continue to ascend, and we're certainly confirmed that might then make this level become our line of resistance, notwithstanding any sort of macroeconomic event or macroeconomic factors. This analysis somewhat agnostic to that. However, if we do fail to break out above this level here, I would expect or not be surprised to see it trade all the way down to this level here, which is like 215, 220, or maybe even all the way down to here, below 200. I think from a technical perspective, those two levels would indicate a very compelling buy zone. If one were to feel comfortable with the stock and the story and feel that it was time to enter, that would be a very bullish buy zone. Or I would say that to a lesser extent, there is somewhat of a bullish buy zone if we break it above this bar here. But nothing is a buy if you can't get comfortable with the story. Again, what we're looking at here is a very long duration compounder. I think that the long duration compounders are good for the tax advantaged accounts, good for uh, set it and forget it style of investing, taking a position, not being too sensitive to the daily price fluctuations. So I think the stock has a very long term compounding story ahead of it. However, where we are now, the price has become pretty heated. The valuation is not anywhere as good as it once was. But again, it's hard to ascertain what a good valuation is on a stock of this caliber. I think it's set up for success in the long term. There's lots of positive momentum there, although it is somewhat exposed to a more discretionary customer base. However, given my experience having it delivered in the workplace, I don't think it's as discretionary as it seems, but still discretionary. So again, it's a discretionary stock. It's exposed to the cyclicality of discretionary restaurant spend. However, given that it's a marketplace and not a singular brand of food, that makes it more insulated, I think. Um, so where we're at now, I just, it's a hold. I'm holding it right here. I think pretty pretty soon that outlook could change given the events of what is happening here. So um, holding because I wouldn't. I've really been uh, pleasantly surprised and pleased with the performance of the shares. And this is my go-to service to get food delivered. But we're not overheated here. We're not at a blow-off top. The price has never made it past this level in force, right below the all-time high. And we really want to see it break out above that before getting confirmation that now's an entry point. But again, if your outlook is long term and you're looking to hold a compounding growth vehicle in some sort of tax advantage account, again, I wouldn't be too. I'm not too concerned about the minutia of 10-20% in either direction, because typically when I'm allocating to something like this at that time, it's a small percentage of the portfolio. So I like the stock, but right here, I would just say it's a hold. But lots of positive catalysts, lots of positive tailwinds. However, where we're at now, but probably not a good buy zone. This is the first video I've made in a few. I definitely rambled on quite a bit, but let me know how I'm doing. Comment below if you enjoyed it. And as always, my viewers get access to 10% off Seeking Alpha subscription, which I use to do lots of this analysis. So please feel free to check the link below in the description in regards to that. So it's been a pleasure. Thank you for watching. I appreciate all my viewers. We've been slowly and steadily growing the channel, and it's been an exciting thing to see. So thank you to all my viewers out there. I appreciate you. And until next time, I'm going to sign off. All right. You have a good rest of your day, and I'll talk to you soon. See ya.